Investments in associates and joint venture. What are these investments in associates, venture, and joint ventures? The standard set out the requirement for the application of the entity method when the accounting of investments in associates and accounting for investment joint venture standard shall be applied to all entities that are investors with joint control of significant influence over investee. So these are for the investment company. What is this kind of investments? They usually have control over the enterprise. They have a significant investment in the enterprise. Once they have a significant control over enterprises, they can cause a significant in control in other enterprises through that invested entities shares. Such kind of thing is need. So you need to see this is investment in associates and joint venture. An associate is an entity over which investor has significant influence. Yes. A significant control is a power of a participate in a financial and operating policy of a decision of an investee, but not control or joint control of the policies. Significant influence, na, they don't have the complete control, but they can influence something. Okay. So the participate in financial operation policy decisions. They have a part in making the decision. Example, they have the board of directors, major board of directors. Ones who controls the board of director controls the company too. If an entity holds directly, indirectly through intermediates or subsidiaries, 20 percentage or more a voting power of the investee. So they hold more than 20%, they are known as significant influence. It is presumed that the entity has significant influence unless it can be clear demonstrated that that is not easy. So when the person hold 20%, then they are controlling significant influence. Significant influence. If they say I don't have significant influence, they should demonstrate and explain why they don't have significant influence. Conversely, if the entity hold directly or indirectly through intermediates less than 20 percentage of the voting power of the investee, it is presumed that the entity does not have significant influence unless such influence can be clearly demonstrated. So sometimes the company may not have 20 percentage voting power, but they may have significant influence. If they say so, they have a significant influence, they should demonstrate how they have a significant influence. A substantial or majority share ownership of another investor, substantial or majority ownership of another investor does not necessarily preclude the entity from significant influence. You have a significant ownership for another director does not necessary to preclude an entity. It's not when another person has 20% of vote. Okay, when they uh, then you not say like he has the influence, I don't have the influence. You can't say the existence of significant influence of the entity is usually evidented in one or more of the following way: how the representation on the board of directors or equivalent governing body of investee. How a significant influence is evidenced. Sir, they have the majority shareholders. They have the majority board of directors. So the participation in policy making process, including participation decisions about dividend and distribution. So they have the major influence in dividend distribution. They are other participations in other decisions. They are the major policy makers. If we found that they do this, they are the decision controls. Material transaction between entity and investee. So this person is an investee and he provides all the material to the company. Interchange of managerial person. Anybody want to change him the directorship? He, if you think so, he can convert it. A policy of essential technical information. So this person knows every technical information. He is a key member person. The existence of effect of potential voting rights are currently exercisable or currently convertible, including potential voting rights held for other entity, are considered as assessing whether an entity has significant influence or not. Equity method is a method of accounting whereby the investment in initial recognition or a cost are adjusted thereafter. The post-acquisition changes in the investor share of the investee's net asset. The investor profit or loss include in the share of investee's profit or loss. And the investor's other comprehensive income includes this share of investees and other comprehensive income. So the equity method, they say what is the equity method? Now what a method in which we should evaluate the holding, how in the cost or adjusted after post acquisitions. And I have done some acquisition costs that both are added back and given a value. That is the in equity method. So the investor in profit and loss account include share of the investor's profit or loss and investors other comprehensive income include in the share of investing other comprehensive income. Usually when they increase the value, they may rather go in two forms. You buy uh, dividend crediting in P&L account, or if they don't want to do so, they can go for comprehensive income. Equity method, the investment in an associate or investment in a joint venture upon acquisition is recognized in cost. In equity method, everything should be accounted in cost. Very good. On acquisition of investment, any difference between cost of investment and the entity share, the net fair value of the investees, identifiable assets and liabilities are accounted as goodwill relating to the associate or joint venture included in carrying amount of the investment. Amortization of goodwill is not permitted. Sir, I bought the company in higher cost rather than lower cost. Now what to do? When you bought something in higher cost, it will be considered as goodwill. Sir, can I amortize the goodwill? No. As per the NDAS, you can't amortize goodwill. Any excess of the entity's share or net fair value of the investee's identifiable assets and liabilities over the cost of investment recognized directly in equity as capital reserve in the period in which investment is acquired. So, next second point. Sir, I bought this company. This value is have increased much manifold. Now, what I do? I want to do in same fair value. So, you can increase it at the same time. You can increase the value and put it in capital reserve. Very good, very good. Just give me the entry, sir. Very good. Entry, you can see, yeah. We bought the asset. So, investment to bank. So now the value of the company is increased. So investment to capital reserve and so well. Mhm. The carrying amount is increased or decreased to recognize the investor share or profit or loss of the investee after the date of acquisition. Because after the date of acquisition, we should recognize whether this is a profit or loss of the investee after the date of acquisition. They should see, not before. Okay. Appropriate adjustment to the equity share of associates or a joint venture or a profit or loss after acquisitions were made in order to account. So the adjustments always to be taken after the acquisition or before acquisition. For example, depreciation of a depreciable asset based on a fair value of acquired date. Unrealized profit and loss on the transaction is associated with the eliminated to the extent of the investor's interest in the investee. So, like when you buy a asset, after buying the asset only, you can charge depreciation. Such a way, unrealized profit and loss on the transaction which are associated with the or eliminated to the extent of investor invest interest in the investee. So how much they can invest and how much they got goodwill. Based on the goodwill, they can reduce the already existing cost. Then Yeah, everything is after that, not before that. Investors, a share of investees' profit or loss is recognized in the investor profit loss account. That should be recognized in profit and loss account. A distribution received from investees reduced to carrying amount of investment. So the some kind of distribution we receive from the investee reduced to carrying amount. Whatever the carrying amount, you can subtract from it. You should not charge to P&L. You don't need to charge it to P&L. The investor share of appropriate interest in investee arising from carrying the investee. Other comprehensive incomes are recognized in investors. Other comprehensive income. So when there is a change in interest, what appropriate change in invest? So share in the proportionate of interest in the investee arising from change in investees are two other comprehensive incomes are recognized in investors other comprehensive. So when there is a change in investee that is being recognized in other comprehensive income, then after when a change arises, that should be recognized in other comprehensive income only. Entity with joint control of or entity with significant influence over the investor shall account for investment in associate or joint venture using equity method except when the investment qualifies for exemptions. Always anything like joint control, significant influence, investment account should be recognized in equity method. But only in some exceptional cases, when the NDA is permitted, you can go for an exemption. NDA is 109 financial instrument does not apply to interest in associate or joint ventures the account for using equity method. Always India is a financial investment does not apply for interest, but account and using equity method. When the instrument contains potential voting right in substantial currently given access to returns associated with the ownership interest in associate or joint venture, the investment is not subject to India's 109. In other causes, the investment contain potential voting rights in associate or joint ventures are accounted for accordance with India's 109. An entity shall apply India's 109 other financial instrument in associate or joint venture to which the extent of equity method is not applied. So India's equity method is also applied when other than India's 109 financial instruments in associate and joint venture. When there is equity method is not been applied, you next step. When an investment in associate, an investment in joint ventures held indirectly, the entity that is venture capital organization, mutual funds or unit trust or similar entities, including investment linked insurance fund, the entity may elect to measure the investment at a fair value through P&L in accordance with India's 109. So when they follow the India's 109 financial instruments, the question arises what we do when we find a fair value. It is an investment linked insurance funds, similar kind of funds, unit trust funds, mutual funds, capital venture organization. In this entity, I have direct indirect control. Okay. So in this investment I can go for equity method. At the same time, I can go for other method also, financial instrument method. So now my problem is that I want to consider only in the value. What is that value? The value is measured fair value. Based on the fair value only, I can recognize. In fair value, any changes happen, I can charge to P&L account, directly P&L account. Entity shall make this election separately each associate or joint venture. An initial recognition of an associate or joint venture. So these may be separately shown and not should be mixed with others. The standard provides exemption for applying the equity method similar to those applicable to India's one time consolidated financial statement. to the parent that is expected to prepare consolidated statement. So when the company is following a consolidated financial statement, they need to show in equity method sums, okay. But at that case also, exemption is being provided. Exemption is provided to state that you don't need to follow equity method. You can follow exemption on a fair value basis. Entities shall above the India is 105 to investment or a proportionate of investment in an associate or a joint venture that meets a criteria of classifies as held or sale. So India is 105 to investment portion when they made the criteria, when they say the asset is held for sale. The entity's financial statement shall be prepared using uniform accounting policies for its transaction and uniform accounting policy event in a similar circumstance unless the case of associate is impractical to do so. Always the accounting policy should be uniform, but it exemption can be only be given when it is impractical to do so. Associate or joint venture uses accounting policies other than those of entity for like transaction events in similar conditions. Adjustment shall be made to make the associate or joint venture accounting policy confirm that those of the entity when associates or joint venture or the financial statements are used by the entities applying the equity method. The associate joint venture uses accounting policies other than those of the entities transaction events similar circumstances. As circumstances we see, the accounting policy should confirm that entity, when associate or joint venture financial statements are used by the entity, is applying equity method. So when you go for some transaction, when you go for consolidation, there may be a problem came out. One company may use equity method, other may use fair value. What is the deal we should value based on the accounting policy that been followed in the company for consolidation. We should not change it as per our will. However, if the entity that not itself an investment entity, it's not an investment entity, an interest in associate or interest in joint venture that the investment entity, an entity may apply the equity method, retain the fair value measurement applied by the investment entity, or retain the fair value applied by the joint venture to the investment entity, associate or joint venture interest in subsidiaries. What we are going to saying here. So the company is not an investment entity, but has an interest in associate joint venture. Okay, that associate in joint ventures are investment entities. So now the entity may, when applying the equity method, retain the fair value measurement. So they want to do investment equity method, but due to the investment entity, India is 110, the fair value measurement applied on the equity investment entity associated with the joint and fair ventures of associated joint ventures of the interest of subsidiaries, we need to follow that. We can't say we won't do, even though they indirectly control this investment entity. Due to their control, they need to follow fair value rather than equity method. The elections is made separately of such investment entity or investment joint venture or later of the date in which investment entity associate or investment entity joint venture is in each recognized. Associated joint venture becomes an investment entity. An investment entity associate joint venture became first became a parent. Sir, we need election. What separately you should see for each investment entity. So this investment entity, how joint venture, what on later on the date, what we need to think. We should see three things. What is it? The investment entity, associate, or joint venture entity is initial recognition. Sir, we should recognize this entity. We should election should be done. Yes. Then associate or joint venture became investment entity. Sir, we have associate, we have a joint entity, but we should consider as per India is 110, or we should consider as an equity method. For that, we should conduct election. Okay. Then investment entity, associate or investment entity as a joint venture first became a parent. Sir, we in this company should be considered as a parent. We want to consider as a parent, we need to conduct an election. Yeah. In the election only we can decide. After application of the entity method, including recognition of associated joint venture losses, entity applies a requirement of Ind AS 109, determine whether it is necessary to recognize an additional impairment of a loss with respect of the net investment in associated joint venture. Equity method should be useful. Okay. So while recognizing an associate, while recognizing the joint venture, very good. The entity applies Ind AS 109 to determine what to determine whether it is necessary to recognize any additional impairment of loss. So I don't want to there any loss. Now we should eliminate it or to respect of the net investment in the associate. So in the net investment, we see whether it is an to consider or not. We should see the entity's loss significant influence over the investee. So, significant influence you should see whether entity loss or not. You see. Its power loses the power to participate in a financial or operating policy decision of the investee. Um, we should see whether what is the financial position. We should consider the loss or profit of the investment. You should see. What I am saying, sir, I have a significant influence over company. We should see every decision to be made and what, sir, this year I have a control or not. If I lose the control, no, I should mention it. Yeah, I don't have a control. Because when I have a control, you could equity method, I'm including everything in my consolidated financial statement and making my value more. But when I lose the control, I can't do it. The loss of significant influence can occur with or without the change, absolute relative ownership level. So the significant influence can be done in both ways. I have the control, but I lose the control. What? I have 20% equity there, but I lost the control. Oh, that is also a part. I don't have the 20% equity, but I have the control, but I lost it. That is also a possibility. Na? So that also is significant influence and loss of the relative ownership level or a change in absolute ownership level. We should think about that. Take in consideration on the loss of significant influence. When I lose significant influence of joint control, a gain or loss recognized in P&L account. So that loss, when that happens, then that should be considered in P&L account. Entity shall account for all the amounts previously recognized in other comprehensive income in relation to the investment on the same basis that it would have been required. The investee had directly disposed of the related assets and the liability. So that all the thing that is being considered in comprehensive income that is relating to the investment that should have required the investee to directly disposed of relating to assets and liability should be charged to be in account. Yeah. So this is the thing. Thank you.